All right, people look at charts, they talk about this all the time. They see this rally and it gets them bullish, but doesn't do you a lot of good after the rally or even during the rally. What can you get and see and find near the beginning of the rally? That's always going to be your best location. Getting long at the beginning of a rally, getting short beginning of a break. No matter how far the rallies or sell-offs go, you want to get at the beginning of them. Do you want to get long in here? It's one thing, but chance of getting chopped up, shook out, and then it goes. What could happen down here with the tools that you use that could give you a precursor or a heads up that a rally is imminent? Well, let's take a look at these numbers over here. 259, 432. Don't get too much into details of 259 and 432. It's like 250 by 450, which means there's less buyers who want to buy it below than sellers who want to sell it above. All right, that's all that means. You see this green dot? That is what we call a laser. The longer it is green, the more longs there are versus shorts. When it goes red, that means there's more shorts than longs over just the last 2 minutes, by the way. And these are the raw numbers. So there's 8 contracts short, 17 contracts long. We don't claim to know all the longs and shorts at all, but it's a sample size. 17 contracts were open long, 8 contracts were open short over the last 2 minutes. Okay. Now, those are pretty low numbers. We play this thing, and what are we looking for to clue us that it's either not going to go down or it is going to go up? Even if you're bearish, is there something that could tell you, hey, don't be bearish, don't be short, don't get short? That's just as important as qualifying a long, right? Who the hell wants to get short immediately take heat? So you're going to disqualify a short or qualify a long. So if we take this, a couple things are going to happen. You're going to see the NASDAQ at the bottom right. Oh, shoot, I went too far. The NASDAQ at the bottom right here is going to, now this is really something that I could pause and so much that goes on in this sequence that happens a lot. It all came down to here. You see all these lows here in the NQ? That's essentially these lows up here in the ES, right? Generally, you're going to fly through that area and you don't want to be stuck long below the yellow line there or below the yellow line there. Okay. There's usually a lot of sell stops. All right. Shaking out weak longs. So watch what happens here in the NASDAQ. They take out, like, elect, trigger many of those sell stops, but then jump right back into the range. See how quickly it comes right back in? Stop it. So we had said in the room real time, David mentioned NASDAQ just got hit below those lows and they come right back. And you see evidence of that here in the ES. They get hit right here and kind of come right back. And they get through this iceberg, just sellers, more sellers than meets the eye, but how easy it got through that iceberg. This is evidence and clues to not be bearish anymore. And if you're bullish, maybe to take a shot, get long at this moment. This is the fire and ready, aim, fire. Number one, a shakeout or head fake in the NASDAQ, even if you don't trade the NASDAQ. Similar head fake in the ES. What is a head fake, by the way? What's kind of the anatomy of why does a head fake help in predicting what's going to happen next? Well, if you shake out longs, okay, just look at this area. If you shake out longs, that means do you have more or less longs now after a shakeout? You have less longs. After you shake out longs, you have less longs. Shaking out longs is the price going down. Got it? So then the fact that it jumps back up, and you could say, just like this action right here, you could say there's less longs here than there was here. Why? Because they just got stopped out on that action. And when you stop out longs, you have less longs. Remember what longs equal. They equal future sellers, don't they? So if you have less longs, you have less future sellers. It's a pretty easy uh, logical conclusion, right? Less longs, less sellers. What is it you would want if you're long? You want price to go up. You think it's going up. Well, would you want less sellers or more sellers if you want price to go up and you think price is going to go up? Everybody would say, of course, less sellers. In fact, you actually have to have less sellers for the price of anything to go up. It's why it goes up. So you get in your ability to read the real time, this movement in the NASDAQ and the ES is giving us examples of less longs, less sellers. A couple other things that happen. Our laser goes from more longs than shorts, green, to more shorts than longs, red. Simply put, green to red. The lasers all through here and all these bars showing more longs, more longs, more longs. And you could see it in the raw numbers, 19 longs, 16 shorts, slightly more longs. Watch that number when I play it. It's even. Boom. Look at that flip. 25-16. Yeah, the numbers are small, but look at the ratio. It went from more longs to more shorts. Just think what we just walked through. We just said less longs equal less sellers. What does shorts, first of all, equal? Future buyers or future sellers? Shorts equal future buyers, right? Don't tell me what you did to get short, because that already happened. That now becomes the past. We're trying to predict the future. So while information about the past is important, it's not as important as right now and what you have to do next, because now we're starting to talk about the future. So shorts equal future buyers. Everybody would have to agree about that. So what does more shorts equal? More future buyers. Another easy logic to conclude or get to. So you washed out and shook out longs on this move and this action in the NASDAQ. You accumulated shorts, which often happens when people are trying to play for a breakout. They're looking to get short, looking for this to get sold and get action like that. And guess what? That is generally what happens. Like a breakout was it was highly probable until something changed. And the advantage and the edge in this business is recognizing change as it changes and as soon after it changes. That's where your advantages are always going to be. How close were you to when this changed, when information switched, flipped? Did you get news? It could be on a headline that comes across the wire. Did you get the news right when it came out? A second after it came out? 2 minutes after it came out? 2 hours after it came out? Hey, did you get the headline before it came out? Because that's a huge edge to know news that's bullish or bearish before it comes out. But either way, being as close to a disruption or a change in the market as possible is where you create your biggest advantage. Going to the example of news, if there's a headline that disrupts the market, meaning it's very bullish, and you know that, I don't care if you've been trading for 10 seconds or 10 years, there are some obvious bullish comments that could come out that rally the market, okay? And if you got that information 2 seconds before it came out, wouldn't that be a huge advantage? Of course, if it's an obvious bullish comment. And is this comment going to disrupt the market? Meaning, is it going to change and go from bearish to bullish? Especially if it's a comment like a war between the US and Iran is imminent. And then, nope, the president said we reached an accord or something. Could you imagine if it was in the market that we are going to start dropping bombs on Iran, markets are breaking, and then all of a sudden comments come out from Iran and the US that no, we reached an accord? That's a bullish headline. If you had it before, you'd be able to clean up, but at least have it when it happens, the beginning of the change, the beginning of the disruption. So this is a disruption when you go from more longs to more shorts. That's all. So this number shows a sample size of that. And when you see it develop, boom, it actually increases. What happens to the chaser? That's these numbers here. That's this profile here. You want to see more white than gray. And you get that. And you get that before it effing rallies. Not even during, and certainly not after. Let me back it up a couple steps. Take a look at just take a look at this chaser, we call it, because it's orders chasing price. That also helps and creates an advantage, because why does price move up? Buyers are chasing it. That's why the price of anything goes up. So it's 535 by 220. I'm not going to get into, this is not just the accumulation of all the bids and all the offers in your and on your price ladder. It's not that. Any dome could do that. This does a few other things that kind of classify them as real, because they're moving, they're changing, they're becoming aggressive. If a buy order moves up in the book, is it aggressive or passive? It's aggressive. If a sell order is moving down in the book, is it aggressive or passive? It's aggressive. We just want to find out orders that move and follow those. And that's essentially what these two numbers reflect. So when you get a ratio 535 by 220, that's bullish. When you go from more longs to more shorts, that's bullish. When you just shook out longs, now you have less longs, that's bullish. And you're saying these things right now, not in 10 seconds, 20 seconds, or a minute. Because if you're saying these things in 60 seconds, look at the difference. Probably 8, 10 points higher in 60 seconds. So this isn't difficult to read. It's just impossible to read if you don't have it. And it's difficult to read if you don't know what you're looking for. And most people that trade, and even most would admit it, never feel like they kicked over the right stone and understand how price truly moves. And yet they're risking money trying to predict it, trying to predict price. So you could see the, I would say, disadvantage if you had to wait 60 seconds or 30 seconds to come to the conclusion that that's bullish. There's some bullish activity down here. So that's what's important. Real time understanding when there's a change that disrupts the market. How close are you to the change occurring? We're like detectives. However, I say it. Well, we have to look for clues and look for tells, and we're ultimately trying to find information that the CME has. Like the CME knows positions. They're obviously not going to kick out positions of all the customers that essentially go through and trade through the CME. The CME knows where buy stops and sell stops are, but they don't give that information out. The stops, right? They don't give out future buy stop or future sell stop order. But the point is, if we had that information, would that not be an edge and advantage? Of course it would. So that's the questions you have to ask. Stop looking for the right answers. Start looking for the right questions. Is this market short? Is this market long? Are there sell stops above or below here? Are there a lot of sell stops below here? Did they just trigger a lot of these sell stops, or longs puked because they couldn't take it anymore and does this washout right here in the NASDAQ? So now it's got much better chance to rally. And just think of yourself, anybody that's listening to this that has traded before. You're, how many times have you got stopped out of a long and then it rallies 20 points? Pretty close to after getting stopped out. How does that feel? Not too good. Well, now your job is to see when the market gets shook out. And generally, when that happens to you, it's because there were a lot of people that got shook out. Don't take it personal. When the market shakes out most longs and does this, there's just a better chance to rally, because you get a lot of the future sellers out of the way. You got to find things that get buyers and sellers either out of the way or brings them into the equation and into your story. If you're bullish, then you're developing a story where there's going to be more buyers than sellers if you're bullish. So what do you need in that story? If you need more future buyers than future sellers, what do you need in that story? You'd like to have more shorts than longs. You'd like to have an accumulation of buy stops above. You'd like to see chasers grow on the bid side, not the offer side. Again, you would like to have a comparison of longs and shorts over the last 2 minutes and then over the last 60 minutes. You'd like to know where the average longs and shorts are short and long from, which is our dotted green, dotted red lines here. The two best support and resistance lines, and you don't have to take my word for it, just go back and keep watching these videos. Just look in this sequence where we go up, kiss it there, come off, kiss it there, there, there. And then this time, and in real time, it ain't going to be resistance this time, the way it was coming up, and it slid right through it. And then when you have great support and resistance lines, they're also great when they don't work because they're excellent pivots, essentially bullish above and bearish below. And you know when people get stuck. And so if you follow the upper right, when we slice through these levels like we knew we would, and the laser stays red, then the upside continues to be the right side. Ask better questions.